Hi and welcome back to the ASX Small Cap Wrap, your formerly fortnight fix of fresh ideas, tasty takes and maybe the occasional spicy opinion. I'm Patrick Polk, business editor at A Rich Life, and I'm joined by Claude Walker, founder and editor-in-chief at A Rich Life. It's only been a few days since our last episode, but given the hot market action we've seen in recent days, we're burning to speak with you all again. We'll try and keep it short today, but no guarantees. Over to you, Claude.
Thank you for that intro. Exciting way to start the show, of course. But g'day all to our listeners. Thank you so much for tuning in and sharing and liking and all that sort of stuff. It's exciting to start to get your first couple of hundred listeners when you just start a new podcast. So thanks for that. In some ways, it's a pity I can't do like ASMR voice really well because I feel like, it'd be really calming for all of us if we just ensured we didn't panic while the stocks are going down. But, the reality is at the moment, every single night I'm going to sleep and then I wake up the next morning and there's like ridiculous stuff has been happening while I was sleeping.
Yeah, it's crazy. I haven't seen anything like this really since COVID. I don't think we're on that level yet, but in the time since, I haven't seen this level of craziness and just fresh news every day.
Yeah, exactly. So it's like the share prices being volatile, and I guess if you're just sort of perusing the newspapers, you would be focused on the fact that share prices have been going down a lot, but the actual the volatility of the details is even funnier, or even more extreme, I should say. On Monday, we had what I'd call a panic day, and I bought some shares because I've just trained myself to do that in a panic day. So, for example, I guess the example I wanted to give is one stock that I already owned shares in dropped from about above $58 to below $50 on open. And I bought some shares just below $50. And then, just a couple of days later, even in the down markets, it's trading above 57. So that's, an easy 14%. In fact, I bought it below 50 and it's above 57 now. So it's like easy 15% bounce, I guess, for nothing other than the fact that any individual stock can get temporarily dislocated when there's this sort of mass liquidation events. So, with that in mind, I asked you, Patrick, to have a look at panic days in general, and you recently published a short article about it. I was hoping you could just talk us through what you found when you delved into the idea of panic days on the stock market.
Yeah, absolutely. So I think the most important thing to note is that they tend to all kind of come in clusters. So if you look at the history of the ASX 200, which goes back to 1991, I should say, basically, there have been 56 days where the market has fallen 3% or more. I'm kind of using that as a loose benchmark for what we're calling a panic day. And when you look at those 56 days, all but seven, occurred during either the COVID crash, the global financial crisis, the Asian financial crisis, the dot-com crash, or the European debt crisis. Except for Monday. So Monday was down 4.23%. The question is that going to be a one-off? We have had one-offs before. I'm not saying it's impossible, but more often than not, they tend to come in clusters like that.
And also, I guess, backing up the theory here that we're talking about, the hypothesis, let's just say what it is. It's that we are going to have a cluster of panic days, right? That's what we're thinking.
That's my feeling.
Yeah. So one of the data points that supports that is most panic days are part of a cluster. Like that's just a fact based on, the recent history that you've looked at. So usually the reason that these things happen in cluster is that panic days are happening because there's something happening in the real world. And that real world thing is usually something that plays out over some time. And you have good news and bad news. And basically when there's some new reality and markets are trying to adjust to it. And then there's, the human reaction to that new reality. So with COVID, we had a series of extremely severe down days with a few sort of sharp, jagged bounces on the way down. but then also it just kept falling for quite some time until the liquidity and the fiscal stimulus, people just had money in their pockets now, and still that started getting paid out and coming through, and then you had this sort of sharp rebound, and that was the markets readjusting to, I guess, the human response to the spread of a virus. This is a situation, well, and what's the virus here, right? I think it's like the anti-human, anti-trade, selfishness virus has swept the world, and we have, as we've seen the Oompa Loompa president take America in a direction not of growing the economic pie, but just trying to take more of the economic pie for itself.
Isolationism, basically.
Whilst shrinking the overall pie. So it's just a terrible new direction, and that is what markets are adjusting to. So the big question on everybody's mind is, will Trump just turn around on a dime one day and be like, oh, actually, no, never mind about these tariffs. I just think it was a bad idea or something. I don't think he's going to say it like that, obviously. He'll be like, the tariffs have succeeded. We're now going to remove them or something. Or he's like, we've done a deal. It's the best deal ever, the most platinum deal. You've never seen such a good deal in your life. And as a result, the tariffs are coming down or whatever.
Absolutely. It's got to be claimed as a victory. He can't do it any other way.
Yeah. No, let's be serious. He's not going to be like, oh, I made a mistake.
I doubt he's ever said those words in his life.
Yeah. Look, the reality is that you think that he's not going to give up, this easily on the tariff plan. The tariffs are going to do genuine damage. In the worst case scenario, that we're going to see the genuine damage to the economy flow through. And so whilst you could say that this is an event that has kicked off volatility in the markets, really I just say that this is just an event that's part of what is quite potentially going to be a structural change. If you do believe that Trump will actually carry through all the tariffs and let that flow through, then we're basically looking at some sort of inflation plus recession, aka stagflation situation. So if that could happen, look, I think my overall thesis that eventually Trump wants markets to go up again is true. And I think that there's some risk to the thesis. So my thesis is he'll succeed eventually. He'll eventually want markets to go up again, and he'll succeed in making that happen. There's one risk to that thesis is that he gets to a point where he would like markets to go up again, but he's not capable of fixing he can't put Humpty Dumpty back together again. And that they continue to languish and there's no rebound. That's possible. I think that he can do really blunt things though, like just do tax cuts, which means more profit go to the bottom line, etc. And so yeah, but there might be fiscal stimulus. I don't really know what's going to happen. It's very hard to predict. I just sort of have faith that he'll want that to happen in the future. But yeah, the risk is, what if he just can't get that to happen?
I think the issue is one of trust, right? Like finance in general is built on trust. You give your money to a bank because you trust them to take care of that money and you trust that you're going to be able to get it out again. The whole financial system is built on trust. And you've got to ask yourself, has the actions that we've seen over the last, 6 weeks or so, has that permanently shaken trust? My mum always used to tell me that, trust can be destroyed in a minute and it takes many, many years to rebuild. So I think that's kind of the potential for how it becomes, as you say, a structural, bear market, potentially recession, and maybe Trump won't be able to turn it around with just words. Now, I could be wrong. That may not happen. But I think it's something to be conscious of. And I think as investors, we need to be prepared for either outcome. Obviously, pessimism is very high right now, but it can turn. And as much as, that's not necessarily my base expectation right now, I've been wrong on these things before. And I'm sure you probably have too. I think every investor has been. So you also just need to be prepared for things to improve again, which means, like you probably don't want to be completely out of the market, but it is worth keeping some of that powder dry.
Yeah. No, I mean, I don't think I ever want to be completely out of the market in the sense that as a sort of avowed long-term investor, like I need to be like mostly holding through whatever does happen. You know, we've got a friend who's definitely getting over the group chat because he's so dedicated to just long-term, cancel out the noise. I'm just focused on my business. How's its business going, etc. And he's so good at that, and he's so not his strategy to think about the ups and downs that, you know, it's boring for him when we're talking about all of these huge seismic events in markets that everyone's talking about, but he only cares about how his companies are going. And I think that there's actually a lot of merit in that. Like, that is ultimately what we're doing as long-term investors. So yeah, to a degree, all the chatter every day this week, everything's so exciting and ups and downs. It is a little bit noise, and in a way, you can just focus on what I would hope are the high-quality stocks in your portfolio with recurring revenue. They're profitable. They've got strong balance sheets, and you know you might have to think about some specific trade or customer-specific issues if they're an American-focused company. But you know, I would hope that. Well, I would think if you're ASX investing, you've got a lot of Australian revenues there as well. And there's no real reason to suggest that things are going to get too gnarly for us in the short term. But, of course, they might. And that's partly what I wanted to talk about as well. So what I'd be concerned about is how this trade war does evolve. So, in particular, the thing that comes to mind is at some point, America might start pressuring Australia to put tariffs on China, and that really would start affecting our economy if that happened. And even just the prospect of that having to happen, or the prospect of America punishing us for not doing that, or whatever it is, even that could definitely upset our market. And that is what I'm probably thinking might be the next panic day. There might be a new panic day we have when Trump turns around and says, Australia, you have to put 20% or 100%, you know, tariffs on China if you want to be in our alliance. Otherwise, you can, you know, look after your own security. And so I'm not saying that'll happen, by the way, but I'm saying these are the kind of things that pop in my head as potential future catalysts for panic days that we might still see in this cluster of panic day. As a result, you know, what did I do? Well, on Monday, I was going more long the market and I was buying shares that were dislocated. And yesterday, I already started moving myself back more to a little bit more of a conservative positioning, and not selling the shares that were the high quality shares that I bought on panic day, but you know, while still making sure I'm overall still ready for more panic days and still ready to buy the shares when they get really dislocated. Because like you might have the market that comes down 20%, but a specific stock that you know really well and you know it doesn't deserve to be down more than the market, but it might be down 40% because specific stocks, especially small caps, they can move way more than the market for no other reason than like there are more buyers and sellers, or there are more enthusiastic sellers than buyers on a specific day. I.e., some guy is panicking. It's human in the end. There's a guy on the other end of the screen because you're in small caps. So you're not necessarily got huge flows of liquidity. There's not necessarily a fund standing behind it all. The fund might be like, you know, maxed out its cash or whatever. It might need to think of having cash in case people are withdrawing from the fund, or the fund might have to sell because it just had a whole bunch of its clients withdraw their cash from the fund, and it has a small cap company and there's no buyers that day, but that fund needs to sell to fund redemptions. And here we are on panic day. And that's when you get a huge dislocation in specific stocks that you know well, that are your quality buy and hold forever kind of core portfolio winners, multi-year, multi-bagger compounders. They might start small. I imagine some of them are big now. But the point is that anything less, you know, on a real true panic day, all manner of stocks are seeing this sort of liquidation behavior. And I guess that there are multiple signs of it beyond the minus 3%. In fact, I would actually say, like, I guess I've got no problem with the minus 3% cutoff for what you call a panic day, especially just to have a good objective way of measuring it and doing your research and analysis, which I appreciate because that's the data that helps inform the view that I already had, and everyone loves it when data supports the view they already had, right?
Confirmation bias is strong.
The truth of the matter is that I'm looking for panic. There's something like smoke to panic. You know, it's something ethereal. It's something in the air. It's something sociological. It exists on the interhuman psychological realm, not necessarily on the quantitative realm. And what are the signs? Like, for example, on panic day on Monday, ComSec was jiggy jaggy. Like, it wouldn't show my portfolio for a minute. A friend of ours is just giving us the running. His running battle to like even log into, was it NAB Trade or something?
I think it was Westpac.
Like Westpac or something. He's like, I can't even log into this system. Like, what on earth?
Who would have thought that CMC Markets was the one that that actually held up after all?
Did it? Yeah. See, I wouldn't know.
Yeah, I had no problems.
Well, there you go. Like, we are not remunerated by any brokers, by the way.
No, don't endorse any of them.
It's not our thing. We're not getting advertising or whatever, not endorsing anyone either.
Not a recommendation.
But either way, look, this is the scuttlebutt when you see people tweeting, "Oi, why can't I get into my brokerage account?" I'm like, that's a panic day sign. You know, everyone has their own personal ones too. Like, my favorite one is like when Dad calls me up to be like, "Oh yeah, you know, how you going? Lots seem to be going on the markets today. Like, you know, any thoughts?" Or the stepfather sends me an article or something like that. Not stepfather, the father-in-law.
Yeah, I think there's a few other kind of potential indicators you can look at. My favorite one is just like the breadth of the sell-off. If you've got a day where the top 20 market movers, like positive market movers for the day, there's actually stocks that are like negative or done 0% in there, that's usually a pretty good sign that it's a broad-based sell-off. I don't know exactly what number I'd put on that. Call it maybe 80, 90% of stocks are down. I think that's usually a pretty good indicator. And then just the wild swings throughout the day as well. A little bit more subjective, but I think that's useful. I guess as well, one of the more objective ones you can look at too is the volatility indexes, VIX. Usually you see a big spike in those, you know, around those panic days. So I think there's a few different indicators you can look at. But one of the guys in our group chat kind of made a good point that I liked, which is basically like, if there's any doubt over whether it's a panic day, it's probably not a panic day. I think there was pretty much universal agreement. I doubt there would be too many people out there who would have said, no, Monday wasn't a panic day. Or if you're talking about US markets, like Thursday, Friday weren't a panic day.
Yeah, if you just go and ask, if you'd gone around to everyone on Monday morning and be like, do you think people are panicking? Do you feel panicky? Like, I think most people would have said yes. And isn't that interesting? Because I feel like this thing that people that vaguely pay attention to markets, you develop an intuition, and that's when, you know, like maybe if you've only been doing markets for a year, you don't know it, or if you're an absolute tourist in it, like you think about your stock portfolio once a year or something like that, but you might have invested for 10 years, but you only think about it once a year, you'd probably be more susceptible for a panic day kind of thing. Like, it's funny, you know, my mate who's nothing to do with markets or whatever, he was telling me how, what did he do? It's like he moved his superannuation from like being invested into the market into cash. Like, you know, just you can change your options on your super fund. At some point when things were gnarly, and then, you know, I guess like forgot about it, and then like just missed the subsequent rebuild for like a year or whatever. And then, or 2 years or however long. I mean, he might have done it in 2022 or whatever, 2023, when markets were coming down. He didn't give me the exact details, but the point is he'd moved it to cash, and then he'd like missed this whole bull run. And then not that long ago, he was telling me, I think, that he'd put it back in the markets.
Oh,
just in time to catch the next leg down.
I actually worked for a super fund back in 2008, right at the end of the global financial crisis, and we were getting people who were calling up like in late 2010 to switch to cash because they'd just gotten like their super statement for FY 09 and seen negative returns and gone, oh, well, I want to be in cash then. And it's like that ship has sailed.
Yeah, exactly. So I think that and that's why I think at the start of this, we said that, you know, as long-term investors, we pretty much have to stay invested. You can't just sell out and go to nothing. Like, I have a good friend, he's a great investor, and in the COVID panic, I think from memory, he either sold 100% or 50% of his stocks. Like, I think he just like sold everything. And then it was an easy decision for him because he'd recently just put it into a new investment vehicle. So he didn't like crystallize a whole bunch of capital gains by doing that. And then I was surprised because like 2 days later, he had been back into the market because he was like so paranoid of completely missing the bounce that he's like, I'd prefer be early and just get wrecked on the way down than miss out on the bounce. And I don't know, I feel like that's wise because he was appropriately scared of market timing. And that also was a lesson for me. I was like, oh, this guy, he kind of nailed it. But at the same time, even he's like, yeah, I don't want to actually play that game. So yes, I definitely do some degree of market timing, and you can call me a fool for doing it if you want, but it has served me well because, as I was saying, it is good to react to stimuli around you. Like, you're a human being that is alive. And you wrote the article about how individual investors have certain advantages. And one of those advantages is like, yeah, I guess you can do that if you want. And you can be wrong, and that's okay. You don't have a whole bunch of clients you have to explain why you paranoidly sold 20% of your portfolio. You can just be who you are and do what you want. But of course, be sensible and don't do something too extreme, because we never know when things will change. Any day Trump could change his mind and start wanting markets to go up. That said, I personally do remain cautious, very cautious at this point, and overall quite conservatively positioned, because I want to make sure that psychologically I'm healthy and able to take take opportunities as they come.
Yeah, I'd agree with that. All that. The only thing I would really add is that I also see a lot of wisdom in the comments you referred to earlier about the guy who was basically just wanting to switch off. And I think that's a good thing to do. Maybe, we're all active investors, so it's difficult to switch off entirely. But, as I said at the end of my article, like, take a breath, relax, go outside, maybe go pat some fluffy dogs or something. And, you don't need to watch the market all day, every day. Look for the opportunities when they're there. But like, if you miss one buying opportunity because you were actually enjoying life, is that really such a terrible thing in the long term? Like, we invest partially because we enjoy it, but also so we can live an enjoyable life, right? The investing itself is not the point.
Hey, yeah, speak for yourself. The investing is totally the point for me. Like,
there's definitely a lot of enjoyment in it.
I've been a bit obsessed with this stuff since I was a teenager. It's like half my life is just like investing and trying to figure it out. It's like actually like the thing. Like it's candy for my brain.
That seems like an appropriate lead into actually talking about some stocks. I believe there was one that you wanted to chat about today.
Yeah, so the company that I wanted to talk about today has just put out its quarterly 4C and happens to be just sort of one of those little microcap stocks that I do own shares in. Its name is Advanced Braking Technology. Its ticker is ABV. And essentially what it does is it sells these special add-on braking systems that mining companies use to make their cars and trucks much safer. So these sort of systems could detect if the car is out of control and automatically slam on the brakes. So basically, it's just making that function of braking fail-safe. And that's literally the name of their brand, by the way, is Fail-Safe Brakes. Anyhow, look, I own shares in this one. It's a little risky little microcap. And it basically, I wanted to also disclose that as I wrote that article 1 month ago, and in that article I said, hey, I'm going to sell a lot of like my non-core riskier positions, not my super high quality long-term buy and hold forever stuff, but my sort of more riskier, smaller kind of stocks that aren't the highest conviction stocks for me. So as a result of that, I sold some of my shares in Advanced Braking, but not all of them. So I just decided, I'd hold on to some, but I wanted to reduce my exposure because when you get a bear market, generally speaking, liquidity in the smaller end of the market dries up. And so basically, what that means is that oftentimes the share price of these kind of smaller companies just goes down for no reason, that like the company didn't do anything wrong, but there's just no buyers for, like, there's not enough buyers. People are liquidating their stocks there for the same reason as me, and they want to have dry powder to spend elsewhere. So Advanced Braking has just a $30 million market cap, and it definitely, as a result, is high risk. So obviously, only the only the old hands would be interested in this one. But it's actually a decent little company because it gets a significant portion of its revenue from, I guess, maintenance revenue and that kind of thing, rather than just the initial sale. So you could look at it as like one of my typical kind of investment theses, where I'm looking for those businesses that razor plus blade model. So there's at least some level of recurring style or transaction style or usage style revenue. It's not purely having to make the sale every single time. Now, obviously, this isn't some 100% sticky software revenue where you have a 10-year customer life necessarily. But look, it's a good little business. It is, it talks about making an underlying profit on in the year, in the most recent quarter in its results. I don't know how much weight you want to give that. I would tend to always focus on the actual cash flows. If we look at that, it was a cash burn during the quarter, and it has been burning cash so far this year, but not badly so. And so the company itself acknowledged this, which I think is very important, and said that, I'll get the exact quote, cash and cash equivalents decreased by 29%. However, receivables has increased by 57% due to increased sales through the period. So, look, we can't see the actual balance sheet until they put out their actual proper full year results, but that's what they said in the quarterly, and that does give you, that basically addresses the thing that I'd be most worried about, which is that, hey, it's cash flow negative. And that, I guess final point is alludes to the fact that it's not a perfect business model because it's, I guess, capital intensive. If they want to make a sale, they have to buy stuff, build stuff, and then ship it to the customer. So, yeah, not the best company ever, but I still own shares in it just because I like this razor plus blade model. And also it continues to grow revenue. And I think we've got a little revenue chart of that quarterly revenue. Obviously, it doesn't go up every single quarter, but you can see the trend there. And that's always what you're trying to look for. There has to be a growth trend, because that you're just going to really never really make that much money in a small cap without a good growth trend, because the entire point is to buy something small that gets bigger.
Absolutely.
That's good. Anyway, look, I get to that weird point where saying, hey, like, here's a whole bunch of noise about what's going on in the markets. Like, ultimately, you don't have to worry about it too much. So I guess this one's just for the people that are going to be thinking about it anyway. But like, key takeaways for me are, look, I remain cautious in this situation because we've got to see how this whole Trump thing's going to resolve, especially vis-a-vis Australia, because they've got beef with China, and that could be a problem for us. So I remain very healthily cautious and positioned accordingly. Still going to buy on panic days. I think that there'll be more panic days. So basically, it's just as we were, get those lists, work on that recommendation, find out the things that are going to, I hope, be hard to do now, but very profitable in a few years when the Oompa Loompa president does want markets to go back up again.
Couldn't have said it better myself.
Well, thanks for listening, and thanks for your time.
Exactly. Yeah. Thanks to the audience. Again, if you can give us a like and subscribe, and we appreciate you tuning in, and I'm sure we'll be back again soon, given how crazy everything in markets is at the moment. So yeah, Claude, also, thanks for chatting today.
No worries. Bye, Patrick.